Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today I have the pleasure of having Hans Box. Hans Box is with Box Wilson Equity. His firm does a lot of funds that invest in multifamily, self-storages, and some other debt classes around multifamily. Welcome to the show, Hans. I appreciate you taking time today.
Oh, thanks for having me, Sakar.
Absolutely. So Hans, typically we get started, asking, hey, your background, how you came around into multifamily and syndications and things like that. Please go ahead and tell us more about you.
Sure. So my background is I'm a CPA by background, practiced with one of the big four firms for a number of years. And then I started buying rent houses back in 08, 09 period. And that kind of gave me the bug to get into real estate. And then I took a big step and quit my job and partner with a guy to get into multifamily. I agreed to fix his accounting if he mentored me and taught me multifamily investing. And so that's kind of how I got started and how I got in my first deal.
Awesome. And I know, Hans, you are a veteran investor and a very astute student of the game. You have a lot of, knowledgeable tips from practical experiences and studying the books of the trade. And some of these innovative things that you have laid out are very valuable for listeners to kind of gain the information and be a better investor. So I want to maybe jump into some of those topics, if you don't mind. Please tell us and share with us that when you are doing syndications, right? What sort of elements you look for in a syndicated multifamily deal, for example?
Yeah. So when I'm looking to invest as a passive investor, there's a multiple things that I'll look at. But one of the first things you want to obviously understand is first educate yourself on all terms and understand multifamily and understand what the terms are you're going to read in a PPM, et cetera. But one of the first things I'll want to look at is I'll look at the sponsor themselves, the person that is the head of the deal that I'll invest in. Do they have skin in the game? Have they invested a significant amount of their own personal funds into the deal? What's their track record? How many deals have they done? How many deals have they managed? And one of the most important things I always want to look for is any deal I get in, whether it's self-storage, and whether this is me as a sponsor or me as a passive investor, I want to see a true value add component to a deal. A lot of people throw around the term value play and yield play. I'm sure many of your listeners have heard that. So I don't believe in yield plays. I think that yield play screams to me, I'm paying full retail price.
Right.
And so why would I want to do a yield play? There's no such thing as a yield play to me. I wouldn't do it.
Right. It's so thin and it, I think, smells more risk for sure.
Exactly. And people think, oh, yield play safe. You're buying a coupon payment. No, what you're doing is you're paying full price. So then if we have a drop in valuation of property, guess whose money gets lost first?
Absolutely.
Your equity's gone.
Right.
So you want to buy value add component. That doesn't mean it has to be, 30% occupied and falling down.
Sure.
That just means there needs to be a way to add value, day one, not actually day one, but be able to force equity into the deal.
Right. Makes complete sense. There has to be a compelling story, whether, you do renovations or whether you bring efficiencies through better management and things of that nature. So that value add component, increasing the NOI, perhaps maybe, even lowering the expenses and things like that.
Yep.
Totally agree. So what would be next in terms of, whether it's fee structures, how the structure is, the managers and things like that?
Yeah. So one of the other big points I'd want to stress to that we try to do with our investors, and that I want to see from other sponsors that I invest with, is transparency. And I've noticed a lack of that as the market has gotten hotter, because as sponsors get more and more equity that's thrown at them, because right now, and it's hard to find deals. But these sponsors who've done well on one or two deals, then suddenly, I guess, decide that they don't need to be completely transparent with everyone, and they can just slide by and getting their equity. And that's one of my big, I guess, issues with a lot of the deals I see that cross my desk is there's a complete lack of transparency on fees. There's lack of transparency on how they're getting to the cash flow. They won't share prior reporting that they have on prior deals. They won't share prior P&Ls, even sanitized stuff that when I ask for it. And so that's one of the first things I notice is that if I'll send a bulleted list of questions to a sponsor that say wants me to invest 100 grand in their deal. If they don't respond to that in complete transparency, I'm basically out. I mean, that tells me something. I mean, you know, what happens if the deal goes sideways? Are they going to be transparent then if they're not being transparent now? No. So, you know, that's really one of the big things I look for. And we do the same. Any potential investor looks to invest with Box Wilson equity, I'll send them whatever they want to see.
Sure.
For prior deals. Obviously, I'm not going to send them investor names and social security numbers, but I'll send you the entire P&L. I'll send you anything you want to see on the deals. So that's one of the big things I look for.
Interesting.
Obviously, you want to evaluate a pro forma and the projections and be able to dive into that. But at a higher level, fees, if you want me to touch on that.
Sure.
Fees to me are one of the other things I look for first when I look to in a deal. One of the biggest is an acquisition fee that's typically 1% to 2% of the purchase price of a deal.
Right.
So you see these on most deals, and there's nothing wrong with having an acquisition fee, but it, in my opinion, needs to be capped. If you're buying a $50 million deal and taking a 1% or 1.5% acquisition fee, that's that's $500,000 to $750,000.
Absolutely.
It's really too high. It needs to be capped. It's just as much work to buy a $20 million deal as it's a $50 million deal. And there's no reason you should get paid double or more than double for that. So that's, if I see an acquisition fee of I typically will question it or probably just not invest, because I don't want the sponsor making $500,000 day one. I want the sponsor to be paid as they pay me. I want the interest of the sponsor to be in line with me. Right. So the first place you do that is you look at fees. And if they're getting a bunch of money up front for an acquisition fee, or they're doing a non-recourse loan, but then they're getting paid a large debt fee, why are you getting paid a debt fee if you're signing non-recourse? It's really, it's really something that I prefer not to see. And there's basically what you want to do is you want to look at the fees and see if are they fair? Do they seem excessive? And then the next step is obviously then just to dive into looking at your waterfall and your compensation and make sure those are aligned with your interests as an investor.
Right. So in a waterfall structure, for example, Hans, it comes in a lot of different variations, and there are various hurdles that sort of come with that. What would you maybe say that what would be a reasonable waterfall structure?
Sure. So I have a pretty strong view on this, and the way I invest with other people and the way our deals are structured. I think there should always be a preferred return. Many of these deals out here that you see, especially in more of the newbie space, where these parts of these mentor groups, you'll see a straight split, like 80-20, 90-10, 85-15. So basically for every dollar paid out on an 80-20 split, for every dollar paid out, the investor gets 80% of that dollar of cash flow and the sponsor gets 20%. So in that structure, you could do a big deal and raise, say, $5 million of equity and be well below and pro forma, maybe only pay 7% return. Okay. But the sponsor's getting 20% of a 7% return on $5 million. That's not a small number.
Sure.
So they're underperforming, but they're still getting paid. They're not
Right.
even having to hit a minimum performance level. So that's what the Pref gets rid of. And that's what the Pref requires. So all our deals have Pref, the deals that I do myself as Box Wilson and the deals I invest in.
Mm-hmm.
So we have to pay an 8%. Typically it's an 8% Pref and then a split above.
Mm-hmm.
So I would prefer to see something like an 8% preferred return to the investors. And then after that, maybe an 70-30 split up to a certain IRR.
Sure.
And it really depends on the deal, on how you structure it. But
Right.
if you have a preferred return, the investor is going to at least make 8% on their money before the sponsor starts sharing in the cash flow.
Makes
And
sense.
that provides an incentive and aligns interest between the sponsor and the investor. So
Right.
that's really my preference.
Right. So a bit of a counterpoint on that, Pref, also there, Hans, is that sometimes I have heard also the comments where a Pref return can sometimes tend to counteract against you, meaning, the accrual, like let's say if you're not hitting your projections and you have, let's say, some down months or quarters where, the asset is not performing at the sort of the reported income level, or, for various reasons, for example, right? So some of the arguments that you hear is that accumulation of sort of interest, dividends, things of that nature tend to, weigh down on sponsor. And if that continues for a long time, let's say, I don't know, maybe a year in a deep value add situation, the sponsor is, discouraged or sort of disinterested in, so it kind of counteracts against the sponsor as well. Would you maybe have some thoughts or comments around that?
Sure. Yeah, I've heard that argument and I don't agree with it. To me, if a sponsor is going to, get behind on Pref, is what you're basically saying,
Right.
and starts accruing Pref and it gets further and further behind,
Mm-hmm.
the kind of your job as an investor is part of what we talked about earlier in this podcast was vetting the sponsor.
Right.
And so if that sponsor doesn't have the, what's the right word? Morality is not the right word, but doesn't have the I guess the honesty to continue to work as hard as they should work in the deal, even if they're behind. I mean, to me, that would just make me work harder and figure out a way, okay, what's the best way to exit this deal that's going to help our investors and help me?
Sure. Right.
Then I wouldn't want to invest with them in the first place.
Absolutely.
Is to really vet that sponsor and feel comfortable with their track record and who they are and if they're transparent and all those items. And I would think if you can get comfortable there, they're not going to be the type of person that's going to say, oh, well, I can only pay 5%. I'm getting I got an 8 Pref, so I'm getting 3% behind every year. It's stacking up.
Right.
I'm just going to quit trying. And to me, you hopefully will have already vetted that sponsor, so you have an honest person that's not just going to walk away from that deal and go do other deals since they can't get paid. Cash flow.
I totally agree with you there. I totally agree. I mean, reward for performance, do a good due diligence of the sponsor, their track record, and the prior deals that they've done.
I'll say it right here. We are behind Pref on one of our self-storage deals right now. And it's because of supply that came online 3 years after we bought it. It's not like we knew about the supply. Right. And it's a big REIT that are building. And so they have a cost of capital of like 4%. And our cost of capital's at least 8, right? So we were paying Pref, and then it got behind because it was hard to stay occupied because we were competing
with another large.
They're basically they're giving away units. And so we're behind on Pref, but we basically decided, there's a good exit plan. We had some relationships, and now we have it under contract to sell, and we're going to hit our projected pro forma, but it's just more of the gain is going to be on the back end on gain instead of cash flow.
Sure.
And
that's such a key point there, that I think communication and having sort of that right exit plan and making those decisions is, this is like, I appreciate you sharing that, Hans, that this is truth on the ground that you want to learn. And, this is such a valuable information you just shared, actually.
Yeah, I mean, I want to be honest. I mean, that's why we have it, is because I want to be incentivized as a sponsor. And I have, $200,000 of my own money in the deal. So I want that money to make a return. So I'm incentivized to find a buyer. And at that time, we found the buyer through working with our partner who's connected in the area. And we found a REIT to buy our deal at a very low cap rate. So
That's awesome.
it's kind of a bird in the hand decision,
Sure. No, that's awesome. That's awesome. I appreciate you sharing that. Now, speaking of deals, Hans, what are some of the elements you look for? Like, for example, evaluating the deal, as we all know, can take a long time, bit more thorough analysis and things like that. So, there are some quick ways sometimes that you can, determine that, hey, is it a deal, not a deal, just based on pure numbers and things like that. Could you share some tips about how you quickly go about just sort of doing a napkin math on deals, and how do you go about that?
Sure. So like if I come across a business plan or an offering that I want to invest in myself, or if I'm looking at a deal with a sponsor, what you want to do is, it's a little different if you're a sponsor, I guess, because I'm always going to dive in much deeper. But let's take first, I look at somebody else's business plan. I'm going to first look at their exit cap rate, see if it's reasonable. Is it like a point and a half higher on exit than it is going in? Do they calculate their going in cap correctly? Many people are much too aggressive on their going in cap. And then I will look at property taxes. If it's here in Texas, especially, I'll look at assumptions. Are they conservative? How are their rents growing? Are they growing at some crazy number? And if they are, then that's okay. But there needs to be a good backup for it, and why. Sure. Which means, what's the comp study? Let me see the comp study. Are these true comps, or are these not really true comps to the product that we're buying?
Right.
And then honestly, I'll look at fees. In that case, when I'm looking at the overall deal, those are the first thing to look at is cap rate, sponsor fees, and then how are they raising rents, or how are they adding value? And if I can get comfortable with those three things, then I can dive in much deeper and start looking at the numbers and the pro forma, and are their expenses normalized? Do they make sense? Things like that. But if I can get through the cap rate, the sponsor themselves, fees, and property taxes, then that kind of gives me my first in. It's like, oh, this looks like an interesting deal. I might want to invest in it.
That's awesome.
And I dive in deeper.
Right. And from our prior conversation there, Hans, you said you are a strong proponent of value add. Meaning there should be a clear story as to how you are increasing the income and lowering the expenses and things like that, right? So there are some deals where you have like a deep distress situations, or a deep value add situations. What are your thoughts on that? Sometimes let's say it's an old owner couple that owning the deal, and they just kind of over the years got behind on, let's say, deferred maintenance and things like that. The occupancy is low. So for a new operator coming in, what would you advise, or do you have any thoughts on these deep value add deals?
Oh, I love them. If you're an experienced sponsor and have experience doing these kind of things, I'd love to invest in those kind of deals. Because to me, that creates the biggest buffer in margin of safety if and or when we have a downturn of any type, whether it's small or big.
Sure.
So I love them, but I wouldn't want to invest with a brand new sponsor that's never done multifamily into a deal that has a ton of hair on it. And you put, you've got to get in a bridge loan typically, and a bridge loan has, typically a 2 or 3 year maturity at your head, and 2 or 3 years to get the thing refinanced.
Right.
So you need to invest with somebody who knows what they're doing, and it has a track record and history. So personally, if I could find a deal like that, I'd invest in, we'd buy it ourselves. Right.
Got it.
But in the same way, I would love to invest with sponsors. We went after a self-storage deal like that about a year and a half ago, 2 years ago, and we underbid. And honestly, I wish we would have bid $1 million higher now, because it turns out we didn't get the deal because of some nuances, but it would have been a great deal. It would have been a great deal, $1 million more than what we bid on it.
I see.
So things like that, yeah, I love value add.
Absolutely.
That's great.
It's safe to say that it is advisable for a deep experienced operator to take on these deals, and deep value add should not be an issue for any of our listeners, as long as they're educated and have a good bit of experience doing it. Would that be correct?
Yeah, exactly. Right. And, there's a difference between maybe deep value add It depends on the market you're in.
Sure.
I don't know that I would necessarily want to take on a vacant 200 unit deal,
Ooh.
but something like that,
Right.
that would take more experience than taking on a 75% occupied deal in San Antonio, Texas, right?
Sure.
So
Sure.
you gotta weigh the risks. I mean,
Right.
there's a certain point where it's too risky, right?
Right. Right.
So you just have to weigh the risk profile of the return.
Right, right. No, I totally agree with you. I think bigger the deal, and if you're like talking that extreme, I mean, they do come across. Sometimes, there are zoning changes and, things like that. And you come across such projects where it's completely vacant for whatever reason. And that's a significant undertaking at that point. And I think any operator of any experience there should be well cautioned to take on such projects. So that's for sure.
Oh yeah, I mean, it's not like many of those are around. So that's why the key is: does a sponsor have relevant experience doing this exact thing? That's
Right.
what you need to figure out.
Right, right. I mean, I've done plenty of houses and foreclosures and vacants and things like that I less care to remember. But that's one thing. And taking on a huge project that's of significant size that's completely vacant is totally different animal. That's for sure.
Definitely.
Awesome. So speaking of this value add, Hans, could you maybe share like what are your favorite elements of value add components, interior, exterior wise, that you may have done in your projects? Like what are the best things that you like to do at your assets?
Oh gosh. I mean, I can give you an example of our last deal we did. I mean, it was mainly, I guess two or three of them. It's curb appeal, obviously. But the deal we bought actually had the curb appeal, but the insides hadn't really been touched. And honestly, simple things as adding black appliances and 2-inch shutters or blinds. We were able to achieve our upside without even doing the rest of the interior rehabs. So I think you want to go for the big bang items. I definitely think our flooring, appliances, blinds, and then a curb appeal to the property itself. It doesn't have to look flashy. It just needs to be clean and well kept. Adding a playground is always a pretty big plus. Or in a bedroom community or something like that. But really, honestly, it's just clean and well run. And management is where rehab's great. I mean, you got to clean up the property, you got to add upgrades to draw, but that's typically driven by the market you're in. So it's not like there's some, proprietary way to fix a property up and make money. It's whatever your submarket is, if you got comps that are getting higher rent, then you just copy them and you will get that rent, right?
Right.
The driving factor is the management company and the manager on site. Because when you think about it, you're paying somebody $40,000, $50,000 a year to sit on a $10 million business. Right. And it's kind of crazy when you think about it. The key is to have a very good management company that can hires good managers and good regional managers to oversee. I think that is the crux of it all right there is the management.
Asset management and the on-site property management.
Yeah, us as asset managers, right. And then the on-site or the third-party management, managing the manager is key.
Absolutely. And do you have a favorite sort of a guideline as to how you evaluate, in like the staff, like how much should be the staff with respect to how large of a deal that's there? So for example, do you have a sort of a thumb rule wherein you say that, maybe we should consider 2 employees per 50 unit, that kind of thing?
It's usually 2 per 100. I mean, that's the rule with multifamily. 2 per 100.
I see.
So if you had 100 units, you'd be a manager and a maintenance guy.
Got it. So my next topic is a bit of a twister in the sort of theory of things, that how we go about analyzing markets and things like that, right? And the way it goes, Hans, is that we have various states that are thriving. There are other states that are, perhaps declining or just not growing as much, right? So as sometimes I try to term it more as saying that some are pure cash flowing states where you don't have a direct story of, strong job growth and things like that. And then there are other states, like for example, let's say cities like Dallas, Austin, or whether it's Orlando, Phoenix, and things like that, right? So where you have these cities have strong job growth and things like that, right? So when the sponsors or other deal investors that are looking at these, what is sort of the guiding principles that you go by? That should they be chasing some of these hot states, as I call it, or should they be maybe more looking at cash flowing states? Could you maybe share some thoughts around that?
Sure. So, I mean, part of it depends on your goals as an investor and your investors themselves are investing with you. I mean,
Right.
if you need cash flow and you need to get to 9, 10, 12%, it's going to be hard for you to buy in LA, right?
Absolutely.
So part of it is going to be driven by that. But honestly, from the way I invest, is we want at least, 6 to 7% cash flow day one, and then going up from there. Because that provides a margin of safety. So typically, we will look at, I would probably rather invest in a San Antonio or a Dallas or a Houston making 8% or than I would invest in a Cleveland and make 11. And the reason being is that to me, the risk is lower in San Antonio, Houston, Dallas, maybe Phoenix, because there's jobs. I mean, there's been years of jobs. Jobs continue to come here. We're business friendly state, et cetera, et cetera. So yeah, you might get more cash flow in Cleveland right now because you're paying at a lower cap rate. So you're paying a lower price for the same stream of income.
Right.
But that stream of income isn't as sure, right? Because the jobs just aren't coming to Cleveland. People are leaving Ohio or Illinois or wherever the example is.
Right.
And so I would rather take a lower return on my money for less risk. And that's just the way I'm wired, right? And some people would rather go buy in LA, not get paid anything, and take the risk that it's going to appreciate because it's LA. Right. And that cap rates will compress even more, although I don't see how it's possible for cap rates to compress anymore in places like LA. So to me, what you have to evaluate is the day you buy it, what is the cap rate and where do you think the cap rate is going to be in that market and your exit plan is. That's what you have to look at. So to me, it's more of a risk decision than anything else.
Awesome. So thank you, Hans. I appreciate your kind words. Please share with our listeners how they can find you. Sure.
So I can be reached at hbox@boxwilson.com, or you can give me a ring at 214-641-6309, and happy to chat about multifamily or investing with anyone.
Awesome. Thank you, Hans. I appreciate you spending time and your experience and wisdom with us. I know you're a wealth of knowledge. I'm sure we'll be touching base in future, and I look forward to having more exchanges with you.
Oh, I appreciate you having me on, Skar.
Thank you.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.